Europe cannot export more to China. China has literally substituted everything Europe is good at, whether it's chemicals, whether it's autos. So China knows it needs to keep a little bit of that growth because what is coming is not very positive. Sentiment is not improving. The real estate sector is still actually doing even worse. What is really pushing China to grow at that level is the rest of the world.
So it was no big surprise when China met its official 5% economic growth target for last year. Growth was boosted by a record trade surplus. So China's relative economic strength, combined with US President Donald Trump's tariff policies and threats to invade Greenland, are making China more attractive for countries seeking non-US trade options. To take a closer look at China's economy and the changing face of global trade, let's talk to Alicia Garcia Herrero. She's Chief Economist for Asia Pacific at the French bank Natixis. Good morning, Alicia. Thanks for taking time to talk to us today. It's no big surprise, as I said, that China met this growth target. But how would you interpret these figures?
Well, we first need to realize that the fourth quarter was actually lower than the average 5%. It was 4.5% to start. We have very poor data since October, November, December have been much weaker. But I think beyond that, meaning the trend is really not upward, I'm sure that the next target will be 5%, if not sure, close to sure. Why? Because they managed, they probably even, frankly, I think they probably tweaked the numbers so that they could keep a little bit for the first quarter, because it's 5 sharp, so we can tell that fixed asset investment were quite low, retail sales were very low. So China knows it needs to keep a little bit of that growth because what is coming is not very positive. We can see that. Sentiment is not improving. The real estate sector is still actually doing even worse. Fixed asset investment in real estate is at -16, at the tune of -16. How can you even imagine any recovery there? What is really pushing China is to grow at that level is the rest of the world. And when your growth depends on the rest of the world, it's not very comfortable, is it? China believes in self-reliance. This is the exact opposite of self-reliance, isn't it? So on top of that, a very important point is that China continues to export this $1 trillion, wonderful figure, but at a lower and lower margin, i.e. making less and less money. Both because corporate profits, we can see, are growing negatively. Industrial profits are negative. Overall, I would say flat. But also because wages, and we have data, actually, we had data out today on disposable income, are actually growing below the economic growth at around 4% for disposable income. Is very low. And why? Because both profits, but also wages, real actual wages, meaning what people actually get, not the nominal wages, what is announced, are coming down. So, when people say, China does not want to grow out of domestic demand. No, China cannot grow out of this. It's very different. Cannot grow out of the domestic demand because there is no profitability. It's what I call profitless growth model. I wouldn't like to be there either. I'm not saying the rest of the world is any better. It's not about comparing because, of course, if you compare, you can see, China is still doing well. But generally, I say it's a very risky growth model. No profits and depending on the rest of the world. That's what it is.
Right. And this differential then between, with wages and growth means also has implications for things like retail sales and trying to boost any kind of domestic demand, right?
Yeah, that is why we are again at very low levels of retail sales. There was a little bit of a recovery. We're back to where we were. It's half real GDP growth. So, you know that people are reluctant to buy even if prices are falling. Now you may say, it's not even, it's because prices are falling. Some economists argue, it's like you wait to buy. I would say China is not yet there in that kind of deflation spiral on the consumer side. Consumers do not want to buy whatever is durable. Durable consumption is really low. Consumer staples, so food, all of that is fine. It's just the reason for this is that they are not sure their income will continue to grow. It's decelerating. They worry about the future. So they only buy what is necessary, what is needed. Any long-term purchase, whether it's an investment, i.e. housing, or a car, a durable good, they're not ready to do it. They need massive subsidies, which have been coming along. No more. Many of these subsidies are gone. And why? Because the local governments don't have the resources to continue to subsidize. So, it's a model in itself that, again, we all have problems. I'm not saying this is, the end of the world. But whoever thinks, okay, 5% growth, cheap, kind of easy peasy. No, it's not easy peasy. China has a lot of issues behind that 5% number.
Right. So it's it's quite a precarious figure, and it's a picture of a sort of a precarious economic growth that you're painting. On the other hand, it's one that the rest of the world is suddenly looking at with licking its lips because of the situation in a way that many countries have been put into. One of the countries that's by President Trump and his tariff policies, and also things like the threats to invade Greenland. There's a lot of issues that many Western countries now have, in particular with Donald Trump. So we've just seen Canada's Prime Minister Mark Carney secure what he described as a preliminary but landmark trade deal. How significant is Canada's reset of relations with China, do you think, in terms of countries looking to China as a savior?
It is very significant because it's not only Canada. We have the UK, and frankly speaking, we just had guidelines to substitute what I would call hard-earned tariffs on EVs, because it took a while for the European Union to set up those tariffs. We are now thinking of basically substituting them with minimum price undertaking, which basically means that the Chinese EV makers get basically the tariff, meaning as a profit, and the consumer in Europe will pay for that. So it's not very good news for the consumer. Why is Europe doing this? Because Europe sees the threat of Trump, 10% additional tariffs because of Greenland. China is not really about the Chinese market. Let me get this straight. Maybe more for Canada, because Canada is a commodity exporter. Yeah, so Canada may actually increase exports to China more easily than Europe. Europe is not about that. Europe cannot export more to China. China has literally substituted everything Europe is good at. Yeah, whether it's chemicals, whether it's autos. So for Europe, it's mostly about getting FDI from China to produce what China knows how to do, and Europe expects to be able to learn from. That's where we are. And that's a very different ball game. Is really because the US is not offering any respite, and Europe knows it's suffering from loss of competitiveness. So China can offer not the market anymore. We've passed that, but the learning curve to get back to European competitiveness is kind of amazing. Yeah, what's happening. But bear in mind, I just came back from Shanghai, that's not China's intention. I'm sorry, that's not. The theme now is China for the world. What does it mean? That European companies, MNCs from all over the world, will produce in China for the world, will export from China rather from Europe. So, we shouldn't have these expectations that we'll have huge amount of FDI in Europe from China and export from Europe. China has the opposite intention, actually. But it is convenient to have this FDI because if we or anybody else, become very protectionist, well, you are inside the system, yeah? You're not only outside the system. For Canada, I actually think that it's smart to do this for a very simple reason, is that if you're cornered, yeah, with the US, with the current Trump administration, you need some fallback solution. And I think Canada is different because of the commodity aspect of it, yeah.
It's interesting because Germany's Friedrich Merz is due to visit China. Keir Starmer, as you mentioned, is on his way there. If you look at Germany in particular, I mean, Germany has quite a lot to lose, doesn't it, if it's suddenly flooded? I mean, its whole industrial base could be threatened.
Yeah. I think Germany, I'm going to be very frank here, I'm sure it's not a surprise for many of your listeners, is captured by a few companies, big companies that rely on the Chinese market to the point of not being able to have policies for their own headquarters. It's as simple as that. They rely heavily on that market. They believe that's their future. When we talk about de-risking, their reading of that is de-risking from Germany rather than de-risking from China. I don't know. I'm not a German citizen. I wouldn't be very pleased with these companies, very frankly, because eventually what is happening is that the innovation is in China rather than in Germany. The fixed asset is in China rather than in Germany. I'm not sure why the German government doesn't react to this. I really don't understand why the German government keeps on relying for its China policy on a few companies rather than looking at the bigger spectrum. Many others are losing out of this, but they don't have a voice. They don't have a voice. So I hope my voice helps in that regard, because I actually think that, China, as you said, Germany has much more to lose if its biggest companies start exporting big time from China rather than from Germany. It's quite clear to me. So yeah. Now, is the government realizing? Well, the latest comments from Merz on India versus China are quite telling. I think the German government is starting to get it, but it still has this massive lobbying, from those that are absolutely dependent on China, given the stock of investment in China. They're trapped in China. Let's put it this way, trapped in China. But Germany is a big country. It shouldn't be trapped in China. If those companies made those decisions, well, now they need to live with those decisions. But the country should move ahead. That's my view.
So, by the sounds of it, the days of Europe seeing China as an economic rival are fairly doomed.
Okay, so look, China is an economic competitor, big time. And there's nothing wrong with that. Yeah, I actually think it's good for Europe to face competition, to restructure, to move up the ladder, to innovate. We didn't have any competition. We would never get out of where we are, which is not a nice place to be. Let's be frank. Europe has lost a lot of competitiveness. I don't mind that. But what we do need to do is to be very aware of where we are, not to believe in this, nice picture that, okay, China will invest in Europe, then we will move up the ladder thanks to China. China will open its market. None of this is going to happen. So while accepting that it's good to have this competition, we also need to upgrade our instruments to compete. A very important example to me, that's why I'm now in Brussels, is the issue that, yes, China is more competitive, but let's face it, a big chunk of that competition is price competitiveness, deflation of producer prices, export prices, and a cheap RMB. That's what it is. A part of that, it's hard to tell how much, say a third, is because they are more competitive in relative terms than Europe. I mean, the gain in competitive. The rest is price competitive. And it is a big loss for Europe, as you can tell, because we don't have any instrument to deal with this. We're not the US. We're not going to say, US Treasury will come and say, currency manipulation, price manipulation. We don't do that in Europe. So we are losing a lot of market share globally because of our loss of external competitiveness. Not productivity only, not innovation only. It's about prices here. And China is, of course, rightly so, if that's the only growth model they have at the moment, because the real estate is where it is, using this actively. I estimated the loss of competitiveness in Europe to be 35% since the end of COVID. 35% loss. This is the sum of the exchange rate plus the price differential. Remember that European prices were at plus 10% inflation only recently. China was in a deflation mode. So just imagine all of that over the years is a lot of price competitiveness we lost.
Can we just break that down? That's very interesting. I mean, I think the loss of competitiveness, I mean, when people talk about Chinese goods flooding the European market, they tend to think of things, low price goods or electric vehicles or another big sort of headline item. But with that sort of loss of competitiveness, it could also affect other sectors. I mean, what other sort of things could be affected by this?
Everything, from turbines to machinery to chemicals. We're uncompetitive across the board. There's another reason beyond. So there's like 3 packs, yeah? One is what I call good cholesterol. China is becoming more productive, moving up the ladder, and all of that is good things, and nobody denies it. But then there is the price competitiveness. Part of that is out of reducing profits, as I mentioned before. It's like bad cholesterol. It's not good for China. It's bad cholesterol because they are exporting by, in a way, suffering, yeah? Exporting without making any money, okay. But it's destroying the European industry. And the third and most important people don't talk about is the long-term competitiveness gain that China is achieving. It's on the way, at least, of much cheaper energy costs than anybody, anywhere. And this is Trump's, in my opinion, Venezuela, many other things we might see, is all about that. The US knows China will have cheaper energy. And that's very inconvenient if you want to run AI like crazy and compete with China. It's not only about AI innovation, it's about deployment, it's about use of AI, yeah? So if it's more expensive, you're done. So Europe is very uncompetitive energy-wise. Moving out of the Green Deal, which is basically what we're doing, won't make anything better. Buying shale gas from the US at the tune of $550 billion, which is our July trade deal. I don't know where we are now. Gosh, that's, it's going to make Europe more uncompetitive versus China. So, Europe is still competitive. I want to end with the point. Europe has still a trade surplus of the size of China. People don't talk about it because we're not a nation. It doesn't rhyme, but it is of the order of China, very close to that. Wow. But it's about 2.5 percentage points of GDP, very similar to China. But we have a big deficit with China. 400 billion nearly US dollar is huge. How can we be competitive with the rest of the world but not with China? How can you explain that? Yeah, that we have such a big deficit. And most people say, oh, don't bother. We're competitive anyway. No, I think that deficit is foretelling the future. We need to read that as a hint of what may happen to Europe, especially because now we have a quote-unquote captive market. Our tariffs into the US are lower so far. Chinese are higher. So we're a little bit subsidized by the US, you see what I mean? That's going to end. So we need to wake up and deal with this price competitiveness. We need to have an instrument for that. And we need to lower our energy prices costs enormously. I think these are the 2 major things we need to do at the current juncture.
Right. So in some ways, just to sum up then, I mean, Trump's tariff policies have helped China in many ways, but there's also a competitiveness issue in Europe that is beyond those tariff issues. And in some ways, even as you say, we have lower tariffs than China. So in some ways, actually, Trump's tariffs are helping Europe.
So far. But as we continue, maybe the second fentanyl 10% will fly. Yeah. In April, when Trump visits China, we're getting 10% more because of Greenland. So, we're converging, unfortunately, on the wrong direction, if you're European, good direction for China. So you cannot rely on that. You need to be more competitive, but you also need to deal with the loss of external competitiveness that China has, in a way, created out of this negative export prices and a very weak exchange rate. China's exchange rate should be at around 3, not 7. If you think of how much China has grown, income per capita wise, the exchange rate is extremely weak. But are we going to see 3 to the dollar anytime soon? No way. So, we know that China is exporting through very low prices. Everybody knows that. everybody. And that's eventually not even good for China, because part of that is unsustainable. As I said, bad cholesterol. Not everything is productivity. Part of that, good. But part of that is not good. And the companies know, because you can see from their profits.
Alicia, thank you so much for taking time today. I know you've come out of a very busy meeting in Brussels to talk to us today, and we really appreciate that. That's Alicia Garcia Herrero, who's giving us this insight into the world, the state of global trade. Thanks very much again for taking the time.